Before we proceed with the program, I would like us all to be upstanding for a word of prayer. So let us pray. Heavenly Father, we want to thank you for the privilege you have given us to gather here today as we share our performance for the year 2021. Guide us, lead us, and give us your wisdom, knowledge, and understanding as we share our story. We give thanks for everything that you have done for us in the previous year, and even what you're about to do for us in 2022. We thank you, we bless you, and we honor you, for it is in Jesus' name that we pray. You may have your seats. So, ladies and gentlemen, I take this opportunity to acknowledge the presence of the KCB Group Chairman, Mr. Andrew Wambari Cairo, the KCB Chief Executive Officer and Managing Director, Mr. Joshua Oigara, the KCB Group Chief Financial Officer, Mr. Lawrence Kimathi. I also want to acknowledge the presence of all KCB Group Executive Committee members here present, all divisional directors, shareholders, investors, analysts, members of the media, and all other fellow KCB colleagues. I also want to take this opportunity to acknowledge all of those who are dialed in online. Karibuni sana. And to the online audience, please feel free to use the chat function. Keep your questions coming. We will have an opportunity at the end of today to take your questions and even review your comments and take your feedback. So the program for today is very brief. I will invite the KCB Group Chairman to come on stage and give his remarks. He will then be followed by the Group CEO and Managing Director, Mr. Joshua Oigara, who will then present the detailed business and economic review. And thereafter, our Chief Financial Officer, Mr. Kimathi, who will then speak to us about the financial results for the year 2021. Once they are done, I will come back to this podium and we will take questions from the floor as well as our online viewers today. So for now, I want to invite our Chairman, our Group CEO and CFO to take a seat on the stage. And as you do that, I want to invite our Group Chairman to make his remarks. Karibu sana.
Oops. Fellow board members, CEO and senior management, distinguished guests, ladies and gentlemen, good afternoon. On behalf of the Group Board of Directors, I am pleased to welcome you to our 2021 full year results announcement. Thank you for finding time to join us today, physically and or virtually, as we reflect on the performance of the past year and what lies ahead for the KCB Group. I take this opportunity to acknowledge all our stakeholders, shareholders, customers, staff, and regulators, just to mention a few, for your unwavering support and trust in our business over the years across all the markets where we operate. 2 years since the outbreak of COVID-19, the pandemic continues to threaten livelihoods across the world. In 2021, the impact of the pandemic was disproportionate on economies and individuals. From an uneven economy recovery to unequal access to vaccines, from growing income losses to divergence in threats. All this exerted a steep toll on economies and households and eventually slowed the recovery process and measures to mitigate the spread of the virus. Regionally, our economies showed remarkable improvement with consistent progression in GDP growth in every quarter of the year, despite periodic scares as the virus continued to mutate and spread. Our optimism is bolstered by a much welcome news from the scientific community that points towards the weakening in severity of the disease attributed to higher vaccination rates. I'm pleased with how we continuously responded by cushioning our customers from the severe economic impact of the pandemic through restructuring of loans and advancing additional support to MSMEs and women-owned businesses. From a business performance perspective, I'm happy to note that the business showed resilience and continued to respond exceptionally well. Our Group CEO will shortly be presenting the full year under review. We started the year with our intentions to improve our position in Rwanda and Tanzania. As a result, we explored the options of purchasing Bank Popular de Rwanda, also called BPR in Rwanda, and Bank ABC in Tanzania to give us a better foothold in those two markets. We were successful in Rwanda with the acquisition of BPR. This has catapulted our business in Rwanda to the second largest bank in the country and gives KCB a stronger edge in scaling our regional presence. We look forward to complete the amalgamation process of the two entities by Q2 of this year. We, however, dropped our bid for Bank ABC after failure to receive certain regulatory approvals within the prescribed timeframe specified in the agreement. Despite this, KCB will continue exploring and pursuing attractive regional expansion opportunities in order to enhance our regional participation, accelerate our growth, and maintain sustainable long-term African success in line with our expansion and growth strategy. In 2022, we hope to advance our foray into DRC to tap into the immense opportunities as the country prepares to join the East African Community Bloc. In addition, within the group, we also plan to merge KCB Capital and NatTrust, the latter being a wholly owned subsidiary of the National Bank of Kenya, to create a formidable wealth, asset management, custodial services, and investment banking arm. The group will also continue to explore new opportunities within our existing markets and beyond. KCB believes in being a purpose-led organization that takes recognition of all its stakeholders and runs a sustainable business into the long term. Our business must nurture and build positive impacts to society and the environment as a responsible corporate citizen. These actions will allow us to earn our license to operate in all markets of operations. This pillar is spearheaded by KCB Foundation and sustainability. In line with our group's ambition to remain positioned and responsive for sustainability, opportunity, and growth, the group joined the Net Zero Banking Alliance and is the only bank in Africa to have made a formal commitment towards aligning our lending and investment portfolios to accelerate the transition to zero emissions economy by the year 2050. In addition, we have made a commitment to increase our green lending book by 12.4% through sustainable green financing and addressing mitigation and adaptation of concerns to our environment. KCB has also integrated an environment and social governance framework into our lending process through environmental and social due diligence process operations. The 9 adopted Sustainable Development Goals are being tracked quarterly with performance indicators enabling us to monitor progress and areas of improvement. To note, in the sustainable space this year, the Central Bank of Kenya circular guidance on climate risk management, which expects all financial institutions to have integrated a plan on how to manage climate risks and have the right environment to convert identified risks into opportunities. This process has kicked off well, and it will be a game changer for the market and banking industry, progressively to progressively internalize and adopt climate change and actions within their portfolio and sectors. On our citizenship agenda, we continue to champion the creation of shared value to our communities through education, environment, health, enterprise development, and humanitarian intervention pillars. In line with our theme as a responsible corporate citizen, KCB will give 1.5% of its pre-tax profits towards KCB Foundation initiatives that are aligned with business expectations and stakeholder concerns. One of the key milestones last year was the extension of secondary scholarship program to university level, deepening our play in supporting the education sector. We are optimistic about the East African economy's inherent medium and long-term potential, despite the geopolitical tensions that we're experiencing in Europe, the lacking threats of COVID-19, and other local developments, including the upcoming general elections in Kenya. The priority is to harness investment and consumption drivers to accelerate the pace of recovery and growth. As growth gains momentum, it will lead to many more opportunities for all sectors of the economy and, in turn, inclusive growth. Finally, I'd like to conclude by acknowledging and appreciating the leadership of our executive team led by our CEO, Mr. Oigara. Thank you very much. In ensuring that the business continues to deliver superior shareholder value. I applaud my fellow group and subsidiary board members for supporting me drive the 2021 agenda. To our staff, we salute them for continued dedication to the business during a difficult and unprecedented period. Allow me now, ladies and gentlemen, to invite Joshua to present the numbers, and I'll be happy to take any questions you could be having much later on this evening. Thank you very much. Thank you.
Thank you very much, Group Chairman. And thanks for all of you who have joined us this afternoon. I know there was a change in the venue, but I will bring you back to the heart of Kencom. So I will just unpack a lot of the items that the chairman has spoken about today, and then I will ask Lawrence to speak about the financial results. So if I look at, David, is my slides moving or? Okay, sorry, so that's, I can move now. So just to give you a background of the group for the years, for the last year, and a lot has happened, obviously, and good to see all of you. We are all coming out of the crisis we faced before, which is COVID-19 across our markets. And we were affected a lot as an organization and our sector. You all remember the issues in 2021. But I'm happy to see that we're coming out of that kind of challenge. Obviously, global resilience remains very strong. The group remains very resolute, large network, very expanded in where we operate in the last year. Obviously, our hinterland remains where we are going to build our businesses in the DRC, which the group chairman talks about. We continue focusing on that market to basically lock in the region that we operate. But we are a large institution, nevertheless, where we are today. We concluded successfully the integration and the acquisition of the bank, PPR, in Rwanda, which is a very good institution, actually. If you look at the network in Rwanda, changed dramatically. A number of customers have improved very strongly on a year-on-year basis, which is very strong for our ambition we promised last year. And if you articulate the model for Rwanda business we're going to have, this is the ambition to become the largest bank in Rwanda and a significant contributor for our businesses across the group. And that is the ambition for the group across where we operate in all the markets. That network last year is just a Rwanda addition, and you will see a little bit more addition this year, our commitment going to the DRC market. I want to give you some background as well around the group, the team. Obviously, we remained very strong as an organization from, and I would say our benchmark is very world-class from a governance perspective of our business. We are quite well decorated and recognized across our global peers. Sometimes on governance, KCB doesn't really have a benchmark in our markets today. The chair, who is here with us today, a board of 11, which is board non-executive and those executive directors, with a couple of committees that we have. Myself, who sits chairing the executive committee with our team, obviously executing the delegate mandate of the board into the executive committee and various committees that run. That is how largely we oversee and guide the organizations we have, which remained very resilient and very strong across the region, something that has at least modeled a number of financial institutions in the region. And a lot of people come into organization to see how do we run an organization that large, and this is the model that runs through. In terms of our organization, I'd like to point a number of the teams that are introduced in the Q3 kind of discussions. So Rosalind, who spoke earlier before me, I was the latest who joined our executive committee. Then we've got new members, but they have been with us. There is from the side, Ben Okello, who is just here as a group credit director. We've got Paul Russo, who runs our regional businesses and doubles up as MD for NBK. We've got Leonard, Dr. Leonard Muithiga, who runs our shared services function, and obviously our general counsel, Bonnie, which are the new ones who were appointed last year. The rest of the team, John Mukulu, Chief Risk Officer, you've known him before. Japheth, our Chief HR Officer, you know him. Sam Makome, our Chief Commercial Officer. We've got our CTO, and that's really the rest of the executive committee. We have directors around. Nastasia is here. I see Reggie. We see Charlene earlier. So you have a number of these senior leaders with us today. If I look at the businesses overall, in terms of our performance, I'm trying to see which side. This is an important homing point to share the story for our own organization. So the aspirations for this year, which I spoke again earlier last year, is really driving an organization holistically is committed to driving a level of excellence for customer service. So the commitment and conviction around success, we measure it, is something that really we live for across our organizations. And our NPS scores has remained one of the strongest convictions around drive where we're going. Last year we had difficulties in our CS, but we see our momentum changing and growing on a year-on-year basis. Our ambition for our asset is to build a 1.5 trillion size balance sheet for our organization. You will see the numbers this year when Lawrence presents them shortly. Most efficient institution in terms of our cost-income ratio. Our NFI ambitions remains at 33%, and our contribution for our regional businesses remains at 20% at the end of this financial year. Those four remains, as the group chair talked about, how do we deliver or enable our customers to really build? And if you saw last year and the year before, that ambition has remained, and I call this the Egyptian eye. It tells you really what the thrust for an organization is, defining our organization being the first in terms of customers. How do we make sure that they get the services they need? And it doesn't matter whether it's, because we have many as customers in organization, the large ones, the larger corporates, the SMEs, and I'll be unpacking that in my next slides. In terms of efficiencies, digitizing all our services using technology, getting mobile-centric in our customers, more engagement, and investing in our regional business as well. So those have remained the model. We call this a beyond banking strategy. It is what we get measured on, and it's how we like to see the turn of our organization. If I look at the next slide, a couple of items I'll speak to, not all of them. So in terms of our transactions model, so customer satisfactions, we like to measure that from what customers tell us. So across the sector, across the industry, I'm proud to say that we remain an organization that customers value the most in terms of their feedback. So the Net Promoter Score, which is measured across sectors, across industry segments, the 53 out of 100, and most of you know how this is measured, is the highest score we've seen in our industry for a number of years now. When I joined in the bank, it was 10, 15%. So we've been building that. And this can compare globally for many best practice organizations. So when I look at the CES score, which is a customer effort score, that has been more difficult last year. And I'm the first to say that as we migrate and adopt new technologies, we do face challenges, but that issues have now actually been resolved. The good story around what you see on the left side in blue is a lot of our transactions are becoming more digitized. Customers are getting more centric. So if you ask Anastasia here or our MD seated in Rwanda or Tanzania, that's an area of focus. We are in the heart of the customer's transactions where business is happening. It's a good focus for us to be able to invest. And if I look at the next slide, you will see, I'm going back, that slide will tell you about a few other areas we managed to focus on. So throughout the pandemic and throughout the challenges, our SME, which is an area that we are dramatically investing as a team, both capabilities, resources, energies. Last year, we doubled the number of SMEs in our portfolio in a 1-year period. And you can measure that through either 48% jump in our loan expansion across last year, by an additional 29, circa 30 billion. And in terms of the growth, in terms of our deposit mobilizations. And that is the support we provided our customers during the period, during COVID. And it's a very well-managed book. So I get very proud in our teams across the region when they see and engage, whether you're a micro enterprise, you're large, you're medium, to drive the ecosystem, because we are very strong at the larger customer level, and that's the future of where organizations are growing. This year, 2022, we intend to grow our portfolio again by 50%. So you can see that it's an aggressive, deliberate growth model for us to home in customers and support the model of growth. If I move forward a little bit more quickly, so on this slide, just reinforcing around the level of transactions, nearly 500 million transactions through our networks last year, of which 98% remains, all of them through the non-branch channels. And this is becoming really the key service points for our organizations, whether it's mobile, agency, merchant POSs, our ATMs, and that transactions increased by 46% last year. If you look at the transactions overall, 4.1 trillion shillings transactions through the network, and half of that has happened through the non-branch channels. These transactions to tell you, so the figures you see within the chart just will tell you 2.1 trillion worth of value. The previous one was in the number of transactions. And you start seeing the benefits, the cost-to-income ratio improving from 45 to 46, ROE increasing from 14 to 22. There's a slight increase in cost of funds in the year, but that is the conviction around implementing the strategy for us to build the investment in this area as we become richly digital in our businesses and we become more efficient in the organization we run. We definitely then deliver revenues from that model of business. So 9 billion shillings of fees and commissions or non-interest income achieved year-on-year basis. Slight reduction in our digital revenue last year because we continue to extend the moratorium or the discounting we have, the non-fees for our mobile transactions last year. You've seen we've spoken about this for a long time. I do believe that our conversation with the central bank this year, including the conclusion of our risk-based pricing model, which is ongoing at the moment, will address some of these gaps we had. But generally, a good flow. If you look at the ambitions and the growth at 13.5% on our total revenue, and this 109 billion is record revenue for the organizations over the history of this organization. So if I look at the contribution for other businesses, which is the fourth priority for us, steady momentum. We added the PPR Bank in Rwanda in September. So this year, you see part contribution. But as we move into next year, you'll see a full contribution. A lot of that is coming through our business in Tanzania, which has done very well, in Rwanda, in Uganda, in Burundi, and South Sudan. Obviously, Kenya continues to do very strongly. So that gives you kind of a context of my summary in terms of what is the ambition for us. If I look at the operating environment, and I'll try to move faster, not to repeat what you actually have seen for yourselves. So in terms of a macro environment and growth, a rebound across all segments and all regions in the market, which in a way is exciting, but also sometimes we don't have a long-term vision. In 2020, there was a lot of fear and gap around compression of the GDPs for most of our markets. And everybody was panicking as COVID-19 was coming in through. But look at the growth. Strong, very strong, high, single digit, but very strong, high levels. You see convergence, whether it's 7% in one market. These economies are growing as faster as you can see within the region and across the world, I must say, in the emerging markets area. None of them is just, except Burundi, none of them is below 5%. So that's an exciting conversation to have, that our heart of business, our investment and growth momentum is in the right place in a population today of close to 150 million people, excluding Ethiopia. If I look at the overall performance of the economy from other aspects, so if you look at what are we doing about our current account deficits, that's again quite well managed in the region. In terms of our own recovery on sectors like tourism, this has been one area which we follow very closely because we have significant exposure on that segment. It has taken a bit longer to recover. Large hotels, tourists coming in from Europe countries, coming into visitors. But that's an area that we continue to see more extended recovery. But I'm confident that we will go back to our very traditional. You can see the projection. It's 172 billion, 88 billion 2 years ago, and 146 last year. And that's what gives us the momentum about the growth we are going to be able to see. In terms of the overall economy views, nothing to say earlier. Most economies quite well managed, strong modeling in terms of the assumptions of the economic growth, good progress in terms of exports, imports, despite the new emerging risks you're seeing in the challenge in Asia today, particularly in Europe. If I look at inflation, nothing new to say that is different. Happy to see the changes in South Sudan. This has been a hyperinflationary economy, a lot of that standing around, and you will see them contributing strongly. And this is the vision for a business that takes much more long-term view. You know, in 2014, 2015, as the economy became hyperinflationary, people were very nervous. But your organization or your bank tends to have a more medium to long-term view in terms of the investment strategy. Chairman spoke about this slide, and I'll spend just a couple of minutes on it. Our ambition has remained to integrate very strongly our investment in sustainability across all our business segments. In our markets in Africa and also in East Africa, we haven't done well as economies in bringing down home the sustainable development goals or ambitions for our environmental, social, and governance principles in our businesses. But we've committed greening our portfolio, 25% in the next few years. We're at 8%. How do we build a model around training our staff, appraising and assessing our portfolios? Last year, we went nearly more than 70% of our portfolio, and those who are much more focused on elements of complying with the guidelines we have issued for ourselves. And we will continue to lead in this initiative to build a more long-term bank. If I look at an area, for instance, specific internally, we have works we've done with the more vulnerable people in the society today, whether it's the Inua Jamii program we've run, our scholarship program that continues to operate across, especially in Kenya, our young jobs creation under Tujiajiri for this year, diversity in terms of our ratio. So equality or dealing with inequalities in the workplace, we've been very focused on that. In terms of our compositions for women at the board level, and also training a very aggressive and specific leadership network for women to build. This is an area that will remain an anchor for the region, and we continue to do so as we build a more sustainable business. If I speak about performance in the market, this so last year was a good recovery. This is December last year, and we continue to see that even as we speak in this year. So the board had made a recommendation, and Lawrence will speak about that, to the shareholders for a final dividend of 2 shillings. We had an interim dividend of 1 shilling, so this is a 3-fold increase of the dividends for this year compared to the same time. So we are coming back to where we were pre-COVID. That gives you a demonstration about our conviction and commitment about what we see the market environment for us going forward. I have just one more slide before. So I'll ask Q Lawrence to be standby as he comes in. This is our giving you just a view about the calendar for our investors for this year. What we have today, we kind of moved a day earlier, but usually we have this date fixed in your calendar. So we will have May for first quarter. We do have an AGM coming up. We do have the second quarter results coming up in August. We do then have the third quarter coming up in November. Those dates are fully packed. We do have an investor call coming in on Monday, which normally follows up for all our investors globally. That David coordinates with Lawrence, and those dates are largely fixed for the financial year. In terms of outlook and ratings, very credible, very strong. Despite the challenges we've gone through in our markets, our rating remains solid in terms of benchmark to the sovereign. The negative outlook was largely because of COVID, but that is where the highest rating you can get today in our markets by Moody's is with KCB as a group. This is the same rate for the sovereign. Big matrices, not much change from what happened last year. So from a global benchmark and rating, you can see what the business, that's an external eye about what the group is looking for. Finally, as I look at recognition, it's important to always mention a global perspective in our business. So best bank in Kenya by Global World Finance. We looked at the best bank today by Euromoney, looking at being ranked one of the safest banks in the continent, or the Fortune Change ranked as one of the 8 globally most sustainable institutions in terms of the engagement we do with our customers, with our staff, with our shareholders. And I think that just gives you the perspective about the journey we've spoken about as an organizations. I will stop there. I've taken a bit more than I thought. Lawrence, I hand over to you to do the financial presentations. We'll take questions at the end. Thank you very much.
Yeah, good afternoon, everybody. Thank you for coming to have tea with us as we enjoy announcement of the results. So I'll take you through the numbers. We'll start with the balance sheet. We had a very good year in 2021, I'll say that. Our balance sheet grew 15% at total assets level, equivalent to about 152 billion. 50 billion of that came out through inorganic growth, which was acquisition of BPR, and 100 was actually organic. So, all the subsidiaries within the group, the work they've done in terms of just organically delivering services and products to our customers. If I just go up and look at the individual lines, you can see customer deposits growing by 70 billion, equivalent to about 9%. Net loans growing by 13%, double digits. It's been a while since we were double-digit growth on loans. And government securities growing by 31% to close at 273 billion shillings. I will unpack those lines shortly, but let me just touch on something that Joshua did present earlier in terms of our channel play, our channel strategy, especially on mobile, and we have seen resurgence coming back in mobile lending. We did review our risk buckets in the year 2021, just to align it to the environment, the changing environment with the growing GDP recovery, and that has contributed to the growth that you see, closing at about 158 billion worth of advances. Splitting those, Fuliza is still fairly important to us, as quarter by quarter performance. You can see it continued growing from 21 billion to 27. But we do have our own products as well. Vuma Loan, which has performed fairly well, been a sort of newish product in the market, and KCB M-Pesa, which a lot of you know about. Coming to the loan book itself, as I said earlier, double-digit growth, 13% to close at 747 billion. I wish this was a Kenya Airways presentation, and we will match that 747 with a plane. But the bulk of that came out of retail. Our personal franchise product continues to perform well, and it does respond fairly well to how the economy performs. Corporate wasn't left behind, delivering about 31 billion in terms of growth, and that came out of mostly the manufacturing sector of the economy. Asset quality, not very good news. We saw that going up from 14.7 to 16.5. Much as we are seeing recovery in the economy, we still have sectors within the economy that are taking longer to recover. Hospitality, especially hotels, is one of the big sectors that is being impacted. From the slides Joshua presented earlier, you could see the number of visitors coming into Kenya dropped to about 300 million from comparing 2019, and only went up to about 870. So still quite far from the 2 million customers that we were getting in 2019. So that has had an impact on our asset quality. The other sector impacted is construction, and construction, I'll split that between infrastructure, so roads. We've got customers there who are struggling. Government is behind in payments, and those being customers who are not delivering, meeting their obligations to us. We've had to take decisions on downgrading them, and also the housing side of construction, what we call commercial loans. We did see a bit of hit coming to those sectors. So that is what has really driven the 16.5 NPL. Did I skip? Yeah. So coming from the asset quality part and looking now at what the impact of that asset quality has been in our book, looking at impairment, ECL, expected credit loss. 2020 was a special year with the pandemic. We took a lot of tough decisions, had massive increases in impairment, carried a large number that we called a COVID overlay in 2020. We've unwound part of that in 2021, but given the asset quality deterioration, we've also had to increase a bit of provisions in 2021. So if we were comparing like for like, then the number of 2021 would have been significantly lower. But because of that asset quality conversation, we've closed 2021 at about 13 billion of provisions. The split in terms of staging, IFRS 9 staging, 1, 2, 3, the bulk of the book still sits under stage 1, which is a good performing book, and a small, I think about 16% is sitting as stage 3. And then the staging also for IFRS 9 provisioning mirrors that staging of the loans. So distributing that asset quality across our key internal divisions. I talked about Chekhov earlier on, which is really the largest part of our retail franchise. 2020 to 2021, we saw an improvement in asset quality. If you recall, 2020, a number of learning institutions were significantly impacted, and we saw those recovering in 2021, and that has driven that improvement. Mortgage, I've just talked about, the stress we've seen in the sector, and also the mortgage book growth in the year 2021 was not as fast as the deterioration in terms of NPL. Corporate continues to be the largest contributor to NPL, sitting at about 19%. So this is a double-edged sword. The good part of it is, there are few big chunky accounts, meaning that we can focus on them and rectify and get them to performing. The con side of it is because they are large, once they start wobbling, then they do have a large impact on the NPL side. And Joshua did talk about our performance on SME and macro. We saw the book grow significantly in 2021, and also the quality of that book has been well managed. Looking at the individual entity performance on NPL, NBK and KCB Bank Kenya are the main drivers of the performance. Good news is the NBK year-on-year has come down, and it has continued coming down actually since we acquired NBK in 2019. So a fairly good story there. The other subsidiaries, single digit, not too much of a concern, but that doesn't mean we don't keep an eye on them. Lastly, I think on asset quality, looking at the coverage ratio, as a result of the increase in the NPL stock, and more so on when we look at the CBK coverage, we've seen that coming down from 66 to 60, just to take account of the fact that we've got to discount the value of some of these securities collaterals as guided by the prudential guidelines. Coming to deposits, 9% growth in deposits overall, closing at 837 billion. You can see the splits in terms of how diversified the portfolio is. We saw a marginal decrease in demand from 67 in 2020, contributing 67% of total deposits in 2020 to 64. It's not a big move, but again, that does drive how we manage our cost of funds, and it's something we are keeping an eye on. We closed the year at a fairly good liquidity of 39% across the board. So a fairly good story on the deposit mobilization and growth within the group. In terms of capital, fairly good headroom. We look at group level, although KCB Group is an aggregation of all the entities, so it doesn't really tell you much in terms of whether there's stress or not. But nonetheless, when you aggregate, you can see we've got a headroom of about 7.2 and 7.5 comparing core capital and total capital. But coming to KCB Bank Kenya, which is the largest subsidiary, you can also see that there is significant headroom on both key capital ratios. I'll point out that one of our subsidiaries, NBK, did not meet regulatory minimum capital requirement at total capital level, just barely missed it by 20 bips, and the expectation is they should be able to generate that from continued business performance, and within the end of the quarter, we should be seeing different statistics from them. Coming now to the profits income statements, and let me start from the bottom. 86% growth at profit before tax, equivalent to 22 billion, to close at 47.8 billion in PBT. And that was mostly driven by top-line performance. You can see at interest income level, 14% growth on interest income, or equivalent to 9.2. And that was, I talked about the growth in our balance sheet, in our loan book, of 13%. We also did grow our government securities investment and the return thereof by 14%, looking at year on year. Interest expense is a red, and that's a function of two things. One, 9% growth on deposits. So, as the absolute number grows, you expect that it will have an impact on interest expense. But more significantly is at the tail end of 2020, we decided to look at our capital structure and inject a bit more leverage on it, more debt. We were not optimally structured from a capital point of view, and the cost of that debt that came at the end of 2020, the impact of the interest we paid for the full year of 2021 has driven that red number. Allow me to just drop down to other expenses, which grew by 12%, equivalent of 5.1, and I'll unpack that a bit later. But that has two aspects: one, inflationary increases in costs, but two, also the consolidation of BPR into our books, which we acquired from August last year, has had an impact on that. I've talked about this in terms of, our earning assets have continued to grow. I think it's about 14%. If you take those two, you add up the blue and the green and compare year on year, is about 14% growth on earning assets, and that has delivered about 77.7 billion in interest income. I'll also point out that we, for the first time, crossed the 100 billion mark in revenues. Total revenues closed at about 108 billion in 2021. The yield coming out of government securities, we can see a sharp drop there from 12.3 to 10.9. That was largely driven by the regional markets. We saw a lot of markets, Uganda, Tanzania, especially those two, dropping their rates within the year 2021. I did talk to cost earlier on, so overall 12% growth year on year. If you strip out the impact of consolidating the BPR, the figure grew by a single digit. We do target year on year growth to be single digit, close to inflation, so that on a real time basis, then the real value, you're basically sort of holding your costs at the same level. There's a line at the bottom there, a green line showing 1.8 to 2.2, and it's called Jaws. I'm sure people are wondering what Jaws, whether that's a movie. Basically, that is a cost Jaws. What we try to measure is your income growing faster than your costs. If it's positive, it means that you're growing your income faster than your total cost. If it's negative, it's the other way. And I'm glad to report that it is a positive 2.2, which means that overall we did grow our revenues faster than our costs. Coming to now just looking at how the subsidiary asset contribution was allocated by subsidiary. KCB Bank continues to still be significant in terms of from a total asset point of view. But I'll say the subsidiaries have grown a lot faster. We shall actually include that information there. All the subsidiaries did grow, with the exception of South Sudan. And South Sudan, in local currency basis, they actually did grow. But because of their translation on the exchange rate, when we translate it into Kenya shillings, then that is showing a negative 6 year-on-year performance. So good story in terms of assets. Looking at profitability as well, 13.7% PBT contribution from subsidiaries outside of KCB Bank Kenya. That figure not too long ago was a single digit number. Again, you can see growth across all of them with the exception of Uganda. Uganda had a one-off in 2020, a significant one-off. So when you compare year on year, that does impact their performance. And these are the follies of enjoying one-offs, is that they come to bite you the next year when you're comparing with your performance. Looking at the key financial ratios, and I will not go through this in too much detail, maybe just to single out a few of them. I did talk about cost-to-income ratio is important for us, closing at 44. Return on equity, which is important for our investors. That number has gone back to the levels that we were operating at prior to COVID. I talked about cost of risk. I'm looking for cost of funds, which marginally grew to 2.8, but to the point I made earlier, we saw a bit of shift coming from our demand deposits, which essentially are current accounts going into term deposits. Liquidity in the market, especially the first half of last year, specifically in Kenya, was fairly tight, and it necessitated us to take a longer term view just to protect our position in terms of ensuring we have liquidity. Same time last year, we came and presented to you what our outlook for 2021 was. That is the dark numbers there, the solid boxes. And this is a report form, now coming back to report to you how we performed against those. NFI ratio, we did not hit our 33% number. Joshua did allude to the fact that there's quite a substantial amount of transactions that are happening from a digital mobile point of view that we are not able to charge because the regulators asked us to waive the fees, and that contributed to that drop to 28.5. NPL ratio, we had promised 14, we've closed at 16.5. Again, I've explained the sectors that are still under stress because of COVID. And then the last one is deposit growth. Our expectation was to grow deposits by 12%. We grew by 9.1%, so we missed the target there marginally. And those are areas that we are focusing on in 2022. So, sorry. Yep. Giving you promise for 2022, in light of where we closed 2021, we are still very, very bullish on NFI ratio. We're looking to get back to the 33 in 2022. Cost to income ratio, we do have planned costs that are coming into 2022 that I'll call them sort of one-offs, but they will have an impact on our cost to income ratio, and that's why that cost to income ratio is sticking to 44%, which is what we closed 2021 at. NPL, we believe we'll be able to correct, restructure, and recover from the 16.5 to 13. Cost of risk, we believe, will come down to 1.8. Cost of funds, almost the same numbers as we've closed at, about 2.7. NIMs, we are seeing marginal improvement from 7.6 to 7.7. Asset yields holding at the same level. Growth in loans, again, bullish, going further up into the mid-teens in terms of growth, same for deposits, and return on equity closing at about 23% for 2022. So that's the outlook that we're looking to deliver, and I'm very, let me not say hopeful, because we don't manage the business on hope, but fairly confident that when we come to report same time next year, we shall be showing that we've ticked almost all of those. So putting everything together, I've talked about this on their own individual lines. The balance sheet, total assets at the 1.4 trillion. We crossed 1 trillion in quarter two last year, and we expect that growth, both organically and inorganically, should continue. We do carry some good momentum into 2022. And then the statement of comprehensive income, again, I have talked about that. Maybe the only number that I haven't touched on is distributable profit, which is profit after tax, which grew by 74% to close at 34.2 billion shillings.